Did you know that there are special retirement accounts that avoid taxes and leave more money in your pockets and provides more investment options than your 401k? Hi, I'm Topher, and today I'll cover level 12 of the 15 levels to financial freedom, investing in your IRA. IRA stands for Individual Retirement Account. That means you, your spouse, your friends, your cousins, everyone can have their own IRA. Each year, you can contribute up to $6,500 into your IRA. There are two types of IRAs, the Roth and traditional. And the taxes work the same way as a 401k. Where in a Roth IRA, your income is first taxed, that money is invested, and as it grows, you can withdraw that money without any taxes. Versus traditional IRA, your traditional IRA is funded with pre-tax money. That money grows in your investments, and then the money you pull out in retirement is taxed. For more visuals and details, check out my 401k video. For 2023, for single tax filers who make over $153,000, they can only invest into a traditional IRA. One of the main benefits of your IRA versus your 401k is that you can open an IRA with any brokerage, Fidelity, Vanguard, Charles Schwab, whereas your 401k is already open with your employer and you're limited to their investment options. Same tips as my 401k video, diversify with a broad US index fund, and avoid high management fees. So try to aim for under 0.2%. Lastly, invest automatically. Set up automatic investments where a portion of your paycheck is sent to your brokerage to invest into your IRA. For example, if you're paid every 2 weeks, set up the automatic investments to withdraw $270 from your bank account every 2 weeks. This will ensure that you always invest money each paycheck and you don't overspend. I received a lot of questions about what to invest in my previous video. Here's more details. First of all, invest in yourself. Learn about stocks, bonds, real estate, and business, and read books and just talk to others. When you buy stocks, you're buying a share and ownership of a company. So if the value of the company goes up, your share appreciates. Or if your company value goes down, your share depreciates. So it's very high risk but high reward if the stock value goes up. For bonds, these are issued by the government when they want to raise money. So you're giving the issuer, in this case the government, a loan, and they are paid back by a specific date while making interest payments. So compared to stocks, bonds are lower risk but also low reward. In the beginning of your investment journey, you may be heavier on stocks because you have more time to grow your net worth and don't need money right away. Whereas later in your journey, you might switch from stocks to bonds to conserve and have less risk in your portfolio. For beginners, I highly recommend diversifying into mutual funds. These are a basket of bonds, stocks, and/or other assets. These have medium to high rewards with medium to high or even low risk because the basket includes so many different stocks where if a majority goes up and some go down, the value of the fund is still positive. Versus if you own just one stock and that stock value depreciates, then the value of your portfolio decreases. There are two types of funds, index funds and actively managed funds. I recommend index funds because index funds mirror a bunch of stocks or bonds and they're not actively managed by a person, so the fees are much lower, usually around 0.1%. Whereas actively managed funds, a person's picking stocks and bonds every day, trying to beat the stock market or beat the index. They usually change the list of securities often, and because it's actively managed by a person, the fees are much higher, usually above 1 or 2%. So in a bear market where most of the stocks are depreciating, the index fund and actively managed fund will probably depreciate as well, but the fee for index funds are smaller versus the actively managed fund. So both are losing value, but do you want to pay someone to actively manage your fund when you're already losing money? Last but not least, you can also invest in ETFs, which are exchange-traded funds. Similar to mutual funds, this is a collection of stocks and/or bonds. The main difference is that mutual funds and index funds, the value stays the same for the whole entire day, so you can buy and sell them once a day. Whereas ETFs or exchange-traded funds can be bought and sold like stocks, so the value changes throughout the day and you can buy and sell multiple times in one day. Thanks again for watching. If you have any questions, drop them in the comments below and I'll address them. Lastly, if you found this video to be helpful, share with your friends and family and invite them to join you on your journey to financial freedom. Thanks again for watching. I'm Topher, and I'll see you next time.